Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Inflation data in America, 60 minutes away. Going into it, equity futures look like this on the S&P 500, firmer by just 0.1% and looking to build on the gains over the previous 2 days. Can we do that? Well, the fate of this market, at least for today, dictated by what happens in 60 minutes when we get inflation. In the bond market, 2s, 10s and 30s look a little something like this. Your 10-year yield lower by 2 basis points to 352.25 on a 2-year yield, just a little bit higher by what, half a basis point, 422 on a 2-year yield this morning. What a finish on copper. Just some massive calls coming through. We're through 9,000 on copper. We did that yesterday. Just for you, Tom.
Thank you.
Goldman's Jeff Curry, 11,500 in copper this year, off the back of Goldman, making a call that China reopening is going to deliver a big, big boom in this commodity market. We're down about 0.4% on the day, Tom, but that's quite a call. And that has to be a factor in the conversation around the inflation story this morning. If we get a softening, if we get more goods disinflation, does China and its reopening completely disrupt that theme? Yeah. In the months ahead?
And very importantly, this is a massive 4+ standard deviation move from -2 standard deviations way out over +2 standard deviations. Whether you're in Chicago or London, doesn't matter. This is copper vaulting higher.
There's a pretty tight consensus for expectations a little bit later this morning. You've got the headline year-over-year stuff, but the banks on Wall Street very focused on the month-over-month core, and maybe for many of you as well, the super core, which we can talk about later. These big banks out with their calls. JP Morgan, Citi, Morgan Stanley, Goldman, all forecasting something like a 0.3% increase in core inflation, Tom, month over month.
It's going to be interesting to see. Our team has done a great job of preparing you for this important inflation report. Michael Pond of Barclays, definitive on inflation-linked debt. Right now, Torsten Slok with us to say he's chief economist at Apollo, his service to Deutsche Bank over the years. And Dr. Hooper, well, guess what? He's been on fire with blistering notes the last couple days. And Torsten, to wax theoretical, as Chairman Powell did, I believe, in the last press conference, throwing out Okins, throwing out Phillips, throwing out all these other theories. I don't know if you mentioned the Taylor model. Wages is what matters to Michael Pond at Barclays. Wages matters to you, and that's a Phillips curve analysis. Is it dated, ancient, and to be forgotten?
Well, the issue today is that the economic models will tell you that we need demand destruction to get inflation to come down. In other words, we need a much higher unemployment rate. But the problem is, maybe inflation today is not driven by demand. Maybe inflation to some degree, and maybe to a large degree, as some Fed working papers show, is actually driven by supply. So maybe we don't need that much more demand destruction. Maybe we just need time to sort out the problems with the supply chains. Maybe we just need time to sort out some of the issues on the supply side. So there's a very important link missing in the Phillips curve and in the economic frameworks that I'm using, that the profession is using, that the Fed is using, which is basically saying that there's a lot of focus on demand destruction being needed to get inflation to come down. But so far, and this is really important, remember inflation peaked at 9.1 in June, now down to 7.1. And if I look at ECFC Go, we'll get 6.5 today on headline inflation. If that's the case, well, then we're trending lower without the unemployment rate going up. So far, it looks more like a soft landing because we're not having that significant increase in the unemployment rate that the Phillips curve would have predicted.
Do we have a trend and an inertial force, to doing physics envy here, do we have an inertial force to get us where Ed Hyman says we're going, which is sub 3% inflation? Does the vector push us down quickly, or do we sit here for a while?
See, that's the key question, and I don't think anyone knows the answer to that. But if we were the Fed, I think we would say, okay, we don't know what the answer
We like to
really
pretend we're the Fed. Continue.
But why don't we just remain hawkish to make sure that we go in that direction? And then we'll remain hawkish as much as is needed until we get down to 2, 3, maybe even 4. And then we can start to take the foot off the brake.
Slock, edge of Blanchard there.
You know, wants a seat at the Fed. Yeah. I'm not suggesting you want a seat at the Fed. Does China ruin all of this?
So the main issue really is that, as you know, of course, all too well, it used to be the case that households in China used to be at home involuntarily. Now, with the virus raging, a lot of households are staying at home voluntarily. So that means that we have not seen, if I look at the CRB index, that has not been moving higher. Commodity prices are not moving higher, as they should have if the China reopening was going to be a big deal for commodities. So at least up to this point, the conclusion must be that it's probably going to be a more drawn-out experience where throughout this year, we will probably get some lift in growth, some lift in inflation. But at this point, at least, it's still the case, even though it has been announced. If it was the case that we had a significant reopening announcement, then commodity prices should be going up. But now they're actually still going down.
The chairman says we're not as restrictive, sufficiently restrictive at the Federal Reserve. Do you think we are?
Well, that still also remains to be seen. I mean, we have raised the Fed funds rate at the fastest rate basically ever. So we don't really know very well. There's a lot of debate also in Fed papers about, has the transmission mechanism of monetary policy shortened? There was a Kansas City Fed paper that said, well, it probably has shortened because now they also have forward guidance and the balance sheet. But at the same time, we're not really seeing anything outside the interest rate sensitive components of GDP slowing down. So housing is slowing down, autos, durable goods. But those are the interest rate sensitive components. But they only make up about 20% of GDP. The 80% of GDP, which is airlines, which is hotels, which is restaurants, I mean, everything from concerts, sporting events, it's still red hot. So there's just not much sign, still quite of a slowdown in the service sector.
I can't imagine the first report you wrote where you knew David Folkerts Landau would read it. He owns the high ground on flows. What's the flow worry out there that we don't see coming right now, given price change? Spain, France, United Kingdom, Japan, China. There's got to be not a rate story, but a flow story that we don't see coming. What is it?
Well, there's a lot of policy things going on globally on yield curve control, as you, of course, have talked about extensively. And what does that mean? That they have widened the band a little bit? Is more coming? And what might that mean going forward for future BOJ policy? Also in Europe, it has turned out now that we still will likely have a recession, but it has turned out in more recent data that it was not quite as bad as we had feared. But nevertheless, Europe still needs to go through energy transition. And finally, to your question, let's not forget the debt ceiling this summer. That certainly is also something.
You think that's a legit point of study?
So I think that one risk and one worry that one could have is start to think about, are the risks of downgrades of U.S. sovereign debt? I don't think that's likely, but we are definitely seeing some risks over there in terms of what that might mean in terms of more volatility in markets over the coming quarters.
How do you respond to people micro-analyzing what we're going to see here in 53 minutes, 31 seconds? Oh my, OMG. Eggs, CPI, eggs are outrageously expensive. How should our audiences react to that?
So I would think mainly in terms of goods and services. It's not surprising that goods is slowing down because that's partly also again interest rate sensitive components, and also that China has been so weak and we haven't seen commodity prices go up. So that's why goods have been slowing. So I think a very important place to look in the CPI report is still to look at services, and perhaps most importantly to look at owner's equivalent rent and all the housing parts of the CPI, because we are all waiting for that to roll over, and Jay Powell has said very clearly we should expect that to roll over. But services is really the area that is most rigid in terms of it takes time before that starts coming down, and the sooner that comes down, the quicker the Fed will turn from this very hawkish stance to a more neutral stance.
How good are we at measuring shadow costs in these inflation prints?
Not very good, because also remember our textbook, as we spoke about with the Phillips curve, doesn't really take into account what is inside the CPI basket. And the CPI basket only, I mean, some areas that are directly a function of wages, which is a big issue at the moment, really are relatively limited to only 25-30%. So in that sense, we're not very good at measuring what the shadow costs are and what's actually going on out there in the economy.
Isn't that a bit messy? Ridiculous almost. Well, we're chasing numbers that aren't really backed up by anything that we experience.
But the Fed and the ECB just had to live with that and say we just have to work with what we got. And obviously, therefore, we all look, and they look much more than anyone else, at all kinds of other data for evidence of inflation. Is it coming down? And it is coming down. Average hourly earnings last Friday is still trending lower to now 4.6 in December. But it's still the case that the level of inflation, which is what the Fed focuses on, and this is very important, the Fed focuses on the level of inflation, but we in markets, we focus on the direction of travel and saying, hey, it's going down, so maybe I should be buying stocks, maybe I should be buying credit. But the Fed would say, no, don't do that, because the level at 7.1 where we are now is still too high.
The problem I have here, including the shock of ending World War II and even the tragedy of Europe before the Marshall Plan, is we have experience with high inflation, which usually, as Krugman's brought this up, and Hyman as well, and others, it comes in with a vengeance. Is that where we are right now?
Yeah, but what I think is also very important is that this whole episode will turn out to be transitory. But the reason why it's transitory is because the Fed reacted. So that's like saying that the patient survived because the patient got the right medication. In other words, we got the right medication from the Fed, and therefore inflation is coming down. So it will not become a prolonged period of high inflation.
How close are they to restrictive? Dominic Constant-Mizuo, just outstanding in his synthesis. He says we're edge is super restrictive right now. Are we? LIBOR back to 2008?
Yeah, so the key answer to that question is the R star and where is the level of the equilibrium exchange rate for the Fed, and that we are definitely above that level today, and that's about 2.5 or so. So in that sense, we are absolutely in restrictive territory. So that also means, as the forward curve on the OIS is telling me, that we should expect to see the Fed begin to cut rates, maybe not in the third quarter, but definitely, in my view, in the fourth quarter or going into next year, because we are in restrictive territory and we need to get back to that R-style level, at, as much as there's some issues about how that's measured, at around 2.5.
You're smiling. Why are you smiling?
I'm absolutely
hate this rate cut chat, don't you?
Fascinated where we are, and the wonderful Torsten Slok is put into a position where he's got to game out what's going to be solved by ex post. And what's going to be solved by is R and R starred and the presumed growth rate, G. We're doing the algebra here, folks. It's Algebra Thursday. Stay with us. And the answer here is we've had, as Blanchard and others talk about Stiglitz, we've had R minus G, which has been a gift for 15 years. Is that gift over?
So I do think that it's over in the sense that we will not have the Fed funds rate go back to zero. At least when I think about what is coming after we have been through this cycle and inflation is back again, then I do think that we will have a new regime where the level of the Fed funds rate will not be zero anytime soon. It will be closer, and this is what I'm guessing the Fed working papers are telling us, be closer to the R-star level of around 2.5.
You mentioned T. Can I finish on T?
Please.
Transitory. I don't want to let that slide. What is it about this moment that you just think is temporary, that you think doesn't stick? Because a lot of people do think we've moved into a higher inflation regime, that we've left behind the pre-pandemic years. Why do you think we haven't?
So the first, of course, thing is that the New York Fed just published a blog post saying that inflation persistence is actually coming down faster. So the first observation is we are seeing inflation persistence improve quicker. But to your point, I do think that eventually a lot of these things will work themselves out, both if the supply chains fix themselves and also if we are in more restrictive territory. That means that demand destruction, which is both in the pipeline, has already happened, will continue to get us back to the 2.5%. So I do think that the reason why it's transitory ultimately is because the Fed wants it to be transitory.
At the espresso bar at Davos, this guy just holds court. When he was at Deutsche Bank, he just holds. You should see this
you
guy
hold court
the room
somewhere
at the
else
espresso
in
bar.
Davos, and it's not.
Yeah,
the
well, I'm
espresso
sure
bar.
Apollo's de-emphasizing it. So maybe
it was the piano
Are you going to
bar.
be at Davos?
No, I will not. Are you going next week?
We haven't decided yet. We're thinking about it. But the answer is Torsten Slok.
I thought we had decided.
That was a clinic. That was a clinic that you just heard from Torsten Slok.
Have you not decided yet?
Huh?
I
just can't decide.
I've made a decision. I'll announce that tomorrow.
I told him I'm not going unless I can bring vet bill.
Oh, you wanted the dog to come and a photographer.
Well, I want the dogs to come
and a photographer.
And the photographers are, that's part of the entourage.
Torsten, a clinic. Thanks for your perspective.
Brilliant.
Thank you, sir.
Just
and
brilliant.
great notes recently, by the way. Thanks for sending them across.
Oh,
really enjoyed them. Torsten
He's on
Slok there
fire.
of Apollo. Inflation data, 47 minutes away.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Traders are betting that U.S. inflation is cooling. That would reduce pressure for aggressive rate hikes from the Federal Reserve. We'll get the latest consumer price index at 8:30 New York time. The projected 5.7% increase would be well above the Fed's goal, but the year-over-year price growth would also show moderation. The U.S. and Japan are taking steps to counter the growing challenge posed by China and its ties with Russia. They announced plans to strengthen defense cooperation on land, at sea, and in space. The U.S. plans to reorganize its forces in Japan so it can deter and respond better to increasing regional threats. Bloomberg's learned that a corrupted file led to the breakdown of an air safety system that prompted flights to be grounded across the U.S. Both the system that provides critical information to pilots and its backup failed. Almost 10,000 flights were delayed. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. And the place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
I've
been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg. Top experts. Great questions.
Deflation of the dollar here, or the popping of the dollar bubble, I think is a very big story for 2023 and beyond. Now, in the short term, I would say dollar is very oversold here. It would not surprise me to see it bounce. We're going to put in what I would call, in my world, a right shoulder in the dollar. I would be a seller of dollar strength.
Chris Verone was absolutely brilliant yesterday, joining us from Strategas, a bad company, live from New York this morning. We're counting you down to the inflation data in America at 8:30 Eastern Time, which is about 43 minutes away. Your equity market going into it looks like this, up 0.2% on the S&P. Yields come in about a basis point. Your 10-year 352.43. In the FX market, euro dollar 107.57. Monster yen strength today. Dollar yen moving lower by 1 percentage point off the back of a report that Japan, a local news report on the idea that Japan may be backing away, Tom, from a policy review, or rather introducing a policy review for next week.
To frame this out for those not keeping score, 150, 140, we went rapidly down to 132. We visited 129 for a spot of green tea, and then back up we came, and now we come down. We haven't tested those yen strengths that we saw weeks ago.
And now there's talk of backing away from yield curve control even more, maybe even completely over a city. China reopening is a big factor for all of us coming into 2023. I know it is for you at home as well. Here's a call from Eric Nelson of Wells Fargo. On the dollar, on the back of this reopening in China, we recommend buying Aussie dollar on dips, targeting a tactical gain of about 4%. The dollar should soften broadly over the next few weeks. Tom, that's a 1 month call, 4%.
Well, these are big
dollar.
moves. No, I'm glad you put this up, John. And this is really important. We're not talking about little tweaks here. A lot of different Wall Street FX types are looking at demonstrable big figure moves.
Tactical is the key word here. Tactical. Are these tailwinds behind some of these moves sustainable? This rally we're seeing in EM equities, bull market, the rally we're seeing in base metals, copper through 9K, Goldman saying 11,500 maybe later this year.
Sterling cast right now. Let's dive forward the conversation as we did. I thought Torsten Slack, how good was he of Apollo? Just brilliant. Awesome. Really, really fancy.
I don't think you have to agree with him to think he's great. He's great. It's just fantastic perspective.
No, it's good. It's been really good.
Great notes he's put out recently.
Michael Pond, maybe sub 2% yield. We continue with Eric Nelson. He's macro strategist at Wells Fargo. And what he brings to this is really serious mathematical panache from Wake Forest and from Johns Hopkins University. Let's look out on the right side of the equation. We're living here in 45 minutes, Eric, and that is the epsilon, the uncertainty out there. What's our level of belief in the data this morning at 8:30?
Well, Tom, we've had two pretty soft CPI numbers the past 2 months. So to see a third one this month would, I think, give the Fed a little bit of comfort coming into the next meeting and perhaps going 25 basis points. I still think, though, the bigger question is the employment cost index at the end of this month. Powell's been very focused on wages, core services, excluding shelter. So I really think the wages are going to have to come in on the soft side or maybe even on consensus for the Fed to be comfortable going 25 basis points. And so abstracting from today's reaction, which could be choppy given the positioning, do think the dollar can continue to soften here over the next month or two.
Well, maybe there's a dollar dynamic to it, but let's stay there on the employment cost statistics coming out in a number of weeks. That's wages and benefits. The Wells Fargo's got a real knowledge base on this with your countrywide heritage. What is the dynamic of pure wages and benefits right now?
Well, I suspect the number that the Fed's going to be really focused on is that private wage number. And of course, we've had the average hourly earning numbers that have come in a little bit on the soft side, that nice downward revision last month. But the key with the ECI numbers is that it's composition adjusted, Tom, as you well know. This is something we're looking at within jobs. What are workers seeing? And that's why the Fed likes to focus on it so much. Now, we have seen a little bit of softness from Q2 to Q3. Question is, did that softness continue or did we see a re-acceleration? I think that a re-acceleration would really spook the Fed, given what they're really focused on here, and that is the very low unemployment rate and the very high level of vacancies.
Eric, I'm looking at your dollar call. It's a tactical call. It's a short-term call. You seem to be cautious about the durability of this, Eric. Can you run me through just why you don't think some of this dollar weakness can hold?
Absolutely, John. To me, it's so much of it is a function of the incredible policy tightening we've had over the last year. The still very significant cost of living squeeze in places like Europe and the UK. I do think that there's been a little bit more optimism than I would expect around the sort of durability of the economic recovery here, and the fact that maybe we can put this sort of energy shock and the interest rate shock behind us. I'm not so convinced. So I still do worry a little bit about global growth over the next 3 to 6 months and beyond. About some of the persistent structural issues in China. Those may be rearing their head again. Need to see more evidence that the global economy can withstand this rate and energy shock before I'm convinced the dollar is heading lower on a more sustainable basis.
Eric, this line you've got, China reopening could be less supportive of CNH over time. Eric, run me through the thinking there.
Yeah, John, this is really a capital flows story. So we've obviously seen a lot of optimism around China reopening. Looking at the Hang Seng or the Golden Dragon indices, these have rallied a lot. And, that's great in the short term. But to me, the bigger issue here is, are we going to see a longer term return of capital to China after what happened last year? I'm not so convinced there. And then maybe more fundamentally on the current account side, you're looking at a lot more tourism outflows. You're looking at a lot more probably goods imports and fewer goods exports as the global economy rolls over here. So to me, that's a pretty negative cocktail for the Chinese currency.
On the dollar dynamics, there's a lot of bets being played right now. And John mentioned a 4% move that we're looking at now. In foreign exchange, is it a big figure 2023? Can you make a legitimate bet?
Well, you certainly have to watch dollar yen, Tom. And I know that's been something you've been talking about this morning. If the BOJ were to move policy again, you could certainly see several big figures in a very short space of time. I do worry, though, that the market is maybe a little bit too excited about a successive set of moves from the BOJ. So, for them to come out in December, change policy, and then say, we're done for a while, this is not normalization, and then do another move, they really risk destabilizing the JGB market and dollar yen. I don't think they want to do that. So I do think coming into next week, dollar yen has actually some upside risk if the BOJ disappoints.
Eric Nelson of Wells Fargo. Eric, thank you. Big call there on a variety of markets, Tom, including the Aussie. Just on the end there, on the Japanese yen. Maybe they disappoint. There's speculation this morning. And it's a major move, let's be clear. I say major, it's a big move relative to what's happening elsewhere. It's a snooze in G10 this morning. But if you look at the dollar against the Japanese yen, 130.71, it's a move of 1.3%. It's a move. And Tom, it's off the back of this local news report that maybe we get this policy review over at the BOJ next week.
You get 5 years of stasis. I'm going to call it at a 110 level. The moving average mark is exactly a 108-ish. And so up you go 108 to 150, weak yen, and you come down. And we've only come down about a third of the way. So they got a lot of room to do to, quote unquote, get back to normal on yen. I'm not predicting a 108, but I'm just saying...
we've had there for the amount of time. It's just been years and years and years of this now. I'm looking at the 10-year JGB at the moment. We've got this new threshold over at the BOJ in the last month or so. It's just 50 basis points, and we're just bumping right up against it, just right up against it at the moment. I think for a lot of people who want to express that yield curve control view, they're not doing it through the bond market, which is heavily distorted and manipulated by the BOJ. They're doing it through foreign exchange.
Yes, I agree with that strongly, that they're using the deepest, biggest playground to play in, because of the liquidity, because of the visibility that you've completely lost within not only in foreign exchange, but in Japan foreign exchange, but in others as well. How come both you and I lean forward when Rosenberg publishes? I mean, that's what you do.
What's he said now?
I don't know. I haven't read it yet. All eyes on today's CPI report. The whisper is that it will be soft, which may help to explain the rally of late. That's just a little blurb there from Mr. Rosenberg getting ready here 30 minutes away.
Without a doubt, this market has been looking for a soft print in this report. That report is about 34 minutes away. Just to go through the estimates for you, your headline number, so this is headline year over year, CPI, we're looking for 6.5%. That's the median estimate. The previous number was 7.1. As I've said a few times, a lot of people on Wall Street very focused on the month-over-month core figure, just to try and establish a trend here. Ex-food, ex-energy, month-over-month, the estimate 0.3%. The previous read 0.2, and then Mike McKee gets fancy quickly, starts stripping all kinds of things out.
He had his morning workout. He's ready.
He said it's not super core. He said it's Powell core.
I like that. I did not know that.
Powell core.
That's very good. He talks to you more than me. He doesn't talk to me.
Because I'm a friendly guy, Tom.
Yeah,
you're a little bristly sometimes.
He sent me the corks.
Did he? David Kelly of JP Morgan Asset Management coming up next.
What do you say to the cynics that say, look, it's all nice and fine, but a lot of it is greenwashing, and you're not a good company, you're just a less toxic company than some of the other oil majors?
Well, the first thing to say is that, I'm a big believer in we need to put ourselves in other person's shoes in life in general. And so I understand that point of view, and I get that people have that perspective. I don't agree with that, obviously, but I understand where they're coming from. We have an enormous challenge as society, which is to provide the world with reliable, affordable, and clean energy. That's what society wants. That's what society needs. And I believe in my heart that a company like BP is actually one of the few companies in the world who can actually make that happen. We can talk about the things that we're going to grow and over the coming years, and I find it hugely exciting and energizing for our organization. But that's what the world needs, and you simply can't go against the grain of society. You can't defy gravity, and that's why we're making the change that we're making.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Fed is really focused on some of the stickier measures of inflation.
They turned out to fall way behind the inflation curve, and I think they're trying to make up for that mistake.
You have this combination of growth prospects improving, but central banks tightening to keep inflation down.
That trade-off between inflation and the U.S. labor market is always going to be in place.
We're kind of moving totally out of the inflation regime. Moving into something new.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz on assignment. Tom Keene, a most important 30 minutes here to go to an inflation report of the United States of America. Much to talk about. Great guest this morning. Vincent Reinhart, the former head of research for the Fed, will be with us in this hour to slice and dice this report. John, simply, why is CPI now so important?
Has been for the last 18 months. It's what the Fed is targeting, and they want it lower, much lower. Will we get another shift lower today? We're expecting that on headline. A lot of people focused on month-over-month call. We'll discuss that. The number drops in 29 minutes. And will this set us up for another downshift step down over at the Federal Reserve to 25 basis points?
Let me go to that right now. I'm going to do it here on the Bloomberg Terminal. FOMC go, because, John, is this report at 8:30 about February 1, or is it about March 22nd, or even the May 3rd meeting?
I don't think they can make decisions about what happens beyond February 1st just yet, but I certainly think
Agreed.
it could set
Strongly
us up
agree.
for 25. The Boston Fed President, Susan Collins, was speaking to Ginna Smidak over at the New York Times just yesterday. She's leaning towards 25. Others might lean towards 50. Be nice to finally see some division on that FOMC, wouldn't it, Tom? Given that the outlook is pretty difficult to make at the moment, at least 1 year out.
I want to fold the market into this because we're moving today. We spent a lot of time on Japan. John, moments ago, SPX prints 4,000 on futures. Standard & Poor's futures up 11. Yes, they were there the middle of December, but this S&P 4,000 is a different 4,000 than 30 days ago.
So the consensus was first half dip, second half rip.
That worked.
Remember that? And all of a sudden,
and dip,
just
or
to
dip
be
and
clear
rip.
here,
I can't
it's
remember.
January 12th. It's January 12th, and we're already having a conversation about maybe some cracks in that consensus. And to be fair, when many of these outlooks were written, do you remember at the back end of October, in November, when all these people get round a table and start talking about the year ahead, we all said the big asterisk there was China reopening. And you needed two versions One version, China's still closed, another version, China reopening. And we're trying to work out what this all means. When that demand kicks back in, does it upset that disinflationary goods trend that we've seen more recently? I don't know.
I will go with that as being the elephant in the room. We've talked about this all morning. Look for Bloomberg Digital and YouTube to help you with that, folks, on the great conversations we've had. John, what I would emphasize is it's more than just China. And what I would look at is how corporations are adjusting, how people are adjusting, and we're adjusting at light speed to what seems to be a nascent disinflationary trend.
Well, how this market's adjusting too. The dire outlook on Europe. I mentioned the European banks. To see European banks,
40%,
banks, 40% plus from the lows of the summer. I mean, these are huge, huge moves. And not just them, the miners as well. Rio, we had Chris Verona Strategas mentioned them. EM equities, high yield spreads in the United States. They're tightening. People are talking about recession in America, and high yield spreads are tighter, not wider.
Brent crude, $84 a barrel. I'm rounding it up there. Can you imagine Brent crude at 90.50? It's a different conversation.
Hey, Jeff Currier Goldman,
We're
bullish.
not there yet.
They're looking for triple-digit crude.
Review copper. I think you've done a great job on that. I look at it sort of, but, Chicago's shut down. LME is open, John.
Through 9K in the last 24 hours. Goldman, 11,500.
Yeah.
This year, potentially. It's a big move, Tom. And largely off the back of Chinese demand kicking back in, which is why I say, and I keep saying it, if you've got this outlook of disinflation, I get it. But does that get upset by what's about to take place in China? That's the unknown.
26 minutes away. I want to do a formal data check, John. I'm going to start with the Bloomberg Financial Conditions Index, still elevated, a positive, accommodative number, not what Chairman Powell wants.
Equity futures with a lift up by 1/3 of 1%. All this speculation last time around that just before the print there was a leak. Gone back and forth on that. Still no real clarity, Tom, as to what happened. Do you remember that? The seconds before the last inflation print where the market started to move on it before it even dropped. Let's hope we're getting none of that. Let's hope we're getting absolutely none of that.
That got some scrutiny. I mean, that got some follow-on scrutiny.
It should.
I agree. There's no question, folks, on the green and the red of the terminal that we saw that as well. Foreign exchange has been front and center this morning. Yen is somewhat stabilized here, off the shock and the news.
Real yen strength. I mean, look, it's a 1.4% move on dollar yen, Tom. Maybe take a snapshot of G10 on the FX screen on the terminal, which is WCRS if anyone's interested.
Very good.
You just see this massive outperformance of the yen, Tom, against the US dollar, and everything else is pretty snoozy.
There it is. Michael McKee set to join us here in a bit. Vincent Reinhardt with all of his expertise in a bit. But we start strong this hour with David Kelly. He's Chief Global Strategist, J.P. Morgan Asset Management. And with his academics in Ireland, he brings an old world tinge to the new world this morning. Is it global disinflation, David Kelly?
Yes, I think it is. I think there's, even with China reopening, we've got softness in the U.S. economy, we've got softness in the European economy. But more than that, we've had time. We had this spike in commodity prices in the middle of last year. We've seen that gives us time to increase production, to increase distribution, to reduce consumption. And even if we see a pickup in growth in the second quarter and later on this year in the world, I think that's given suppliers time to get commodities to market. And because of that, I don't expect much of an inflationary impulse out of a Chinese reopening. And I think the big story still is inflation coming down over the course of this year.
David, what are the chances that the Fed is done after February?
I don't think they are. I wish they would be. I think they need to stop. This is a war that they've won, and they're in danger of tipping the economy into recession. I think they're making the fiscal problem worse. So I wish they would be done. But no, I think the debate right now is 25 basis points on February 1st. If we get an at consensus number or a below consensus number today, then I think that locks in 25 basis points. But I think the way the Fed, the majority of the Fed are thinking about this is they want to go 25 in February, they want to go 25 in March, they want to go 25 on May 3rd, and then hold it through the end of the year. That's what they want to do. The question is, will the economy be strong enough to allow them hold rates at that relatively high level? I think we'll sort of see that as the year plays out.
What are we learning so far about that, David? Is it still too soon to draw any conclusions about how resilient this economy is?
It is. I mean, what we know for sure is the economy is going to be growing slowly. We're at full employment, and we've got very little demographic growth. We've got a very low saving rate, and I think that's a big problem because what's happened is consumers have been living beyond their means for the last few years because of government handouts. And if they sort of try to normalize that saving rate, if they stop increasing their borrowing as much, that's going to slow consumer spending. Meanwhile, we're getting sandwiched by a high dollar, and by very weak residential construction, and that's going to slow the economy. So I think we get no more than about 1 to 1.5% growth at best, but we could still avoid a recession. I mean, we're on the edge of something here, but it looks more like a swamp than a cliff.
Yeah, this is really well said, the idea that we're on the edge of something. David Kelly, with all the ambiguities that we have now, I'm going to voice Neil Duddy here of Renaissance Macro, the idea that yes, growth may come down, yes, wage growth may come down, but if we disinflate, real incomes could be stable, or actually real incomes, inflation-adjusted incomes could increase. Is that feasible?
Yes, it is feasible, at least in terms of wage income, but you still don't have any, you still got the hangover of government transfers going away. And with the personal saving rate at 2.4% right now, remember it was 7% in the second half of the last decade. So you could have income growing faster consumer spending as that saving rate goes up and still have very weak consumption. So I think even with some income gains, we're going to have very weak consumption.
What is your call on housing? Is a broad statement, rents, OER, home ownership, etc.
Yeah, I think we're already seeing rents crack. In fact, I think one of the many nefarious effects of this bonanza in terms of government stimulus during the pandemic is that it allowed landlords to increase rents on people who temporarily had the cash to pay them. But these people don't exist anymore. And so I think that's already pushing rents down. I think it'll push them down further. I just think that government data is very lagged on this in terms of inflation. But I think rents will slowly come down. I think single-family home building is going to be slow, but multifamilies continue to be pretty strong here. And remember, the housing industry never was booming. So even if it is in a slump here, it's not having the same impact on the economy as it did in the first decade of the century.
David Kelly of JP Morgan Asset Management. David, thank you, sir. Thank you very much. We are about 20 minutes away from CPI data in America, going into it. A bit of a lift on equity futures. Tom mentioned that a few moments ago. Equity futures up by 1/3% on the S&P 500. Yields look a little something like this in the bond market, lower by 3 basis points. Tom, at the moment, looking at a 10-year. Just a little bit lower to about 350.
We haven't talked enough about the real yield, a 127 on the real yield. Real yield comes in with further curve inversion. I mean, as I said, the ambiguities, which is sort of microeconomic talk. Jeff Curry would probably give me a quality C at Chicago in microeconomics on that. But the bottom line, John, is it's a jumble. It's the whole thing now.
Hey, Tom.
20 minutes away is a jumble.
Third year of pandemic economics.
Yeah.
Every single time the consensus has got it wrong. Why would this year be any different with China kicking back in?
Shout out. Yeah. Alexandra Harris just publishing, and who does she quote on the LIBOR news of LIBOR back to 2007?
Go on.
A real benchmark for the time of Tim Geithner and Secretary Paulson and that. Priya Misra. Priya Misra on LIBOR back to 2007. This is a real moment for global Wall Street. It is supposed to reflect bank funding costs. As reserves are falling, banks are paying up for funding. And I take what Ms. Misra, with all of her brilliance, is saying there to what's tomorrow after the inflation report. Bank earnings start. It will be fascinating.
JP Morgan, Bank of America, on to next week, I think Tuesday, Morgan Stanley, Goldman. Do you know who's coming up in the next hour? Priya Misra of TD.
I did not know that.
Yeah, looking forward to catching up with her.
Oh, this is the next hour. She's on radio or on TV?
On TV.
Oh, okay. Thank you.
9 a.m. Eastern Time with Jim Bianco Research. Catching up with Jonathan Goller of Credit Suisse as well around the opening bell at about 9:30 Eastern Time. Coming up on this programme, after the inflation data, we'll catch up with Vincent Reinhardt of Dreyfus and Mellon. Up next, Will Kennedy, Bloomberg's very own.
We have Will Kennedy in it.
Joining us on the studio, who heads our world-class commodity coverage. He's going to drop by the studio here in New York. And Mike McKee's going to give you the playbook on what to look for in this CPI print in about 18 minutes.
Yeah, Will Kennedy's like the Three Stooges. Cotton. You have no idea what I'm talking about.
What are you talking about?
Cotton.
I just want you to keep going.
Cotton. Mulberry Curly.
Okay.
Cotton. Except copper.
You want to do that voice for copper?
Copper.
An oil?
Copper. It's my Curly imitation.
All right,
I can do this. You ready?
Are you done?
That's a lot of skill.
Our folks in radio do not want to see that. Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Well, Sam Bankman-Fried says don't blame him for the collapse of his FTX crypto exchange. In a blog post, Bankman-Fried blamed crashing markets and an attack from a rival. He wrote, quote, "I didn't steal funds and I certainly didn't stash billions away." Bankman-Fried has pleaded not guilty to fraud and campaign finance law charges. Investors and the Federal Reserve will be looking closely at today's U.S. Consumer Price Index. The projected 5.7% increase would be well above the Fed's goal. That would help explain its intention of keeping interest rates higher for longer. But the year-over-year price growth would also show moderation. The CPI is out less than 20 minutes from now. President Biden's efforts to quell a controversy over classified documents in his private possession has become more difficult. Aides have found a second set of papers, and that's likely to fuel criticism from Republicans, even though they dismiss more serious accusations against former President Trump. American Airlines posted preliminary fourth quarter profit and revenue that beat estimates. The carrier was helped by robust holiday travel demand. Americans' results support large U.S. airlines' claims that the industry will continue its recovery from the pandemic in 2023. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
We have this combination of sort of a soft landing in the global economy. The worst case scenario didn't happen because natural gas prices in Europe came down because, it's warmer. Energy prices have come down. So that's really lifted some of the growth prospects there. And of course, China's reopening. So you have this combination of growth prospects improving, but central banks tightening to keep inflation down.
Kathy Jones of Charles Schwab there, weighing in. We are about 14 minutes away from inflation data in America. Going into it, equity futures look like this on the S&P, up by 1/3%. Yields come in, Tom, by 4 basis points. Your yield, 350.
Very good, John. We're going to get started here at 8:16 a.m. here with the inflation report coming up. Michael McKee to join in a minute, but Will Kennedy with us right now, and maybe on the linkage of inflation and commodities. Is it commodities inflation, or, as John has mentioned all morning, copper is just a statement on China reopening? I mean, to me, that overwhelms any industrial inflation.
We went into the start of the year with copper looking quite tight. Stockpiles are at very low levels. And, with people thinking about China reopening, investment, we got some news from China this week that they're going to invest many billions in their electricity grid. And that is just a huge demand driver for copper. So people see this as a very strong story. And, of course, with copper, that feeds directly through into the wider economy and raises costs for people.
Does it does it float over to other things like aluminium? Did I do that okay?
Aluminium, yes, absolutely. Aluminum is driven by
It's kind of you will.
By things like investment in electricity too, and just your growth in China if they are going to boost the economy with spending. I think a lot of different metals look tight, and then there's the broader long-term picture of the energy transition, which drives huge demand for copper, nickel, new metals like lithium, and I do think many people see a strong story there.
So we drained the SPR aggressively last year. We were told they're going to try and refill it in and around 70.
Yeah.
And now China starts to reopen, and I just wonder if we get back to 70.
I don't think that there are many people seeing 70 at the moment. I mean, people are feeling quite bullish about oil right now. Jeff Curry was on yesterday saying 110 is the Goldman view.
Triple digits, yeah.
Yeah, we've got hedge fund managers like Pierre Andorand, who's always bullish, but, called up 140 last week. There are a lot of optimistic views there about oil. Ultimately, it will depend on how far the economy slows here. But absent a really deep recession, 70 isn't really the vibe in the markets right now.
I don't expect you to have the numbers to hand, but could you guide us, at least give us an understanding of how much the Chinese built stockpiles over the last year? Did you see any difference in the Chinese imports of crude over the last year when they were locked down?
Yes, they weren't buying crude at the pace you'd expect. I think that they'd filled a lot of it. I mean, it's a very opaque thing. I mean, the Chinese do not tell you how much crude they have in a stockpile. They clearly bought a lot of oil in the early stages of the pandemic when we had record low prices. And those strategic stockpiles were probably pretty full. Refiners did not get the import quotas that as high as they're getting now. So, yes, there was a dampening in demand to some extent, and I think it's reasonable to expect if we do fully reopen in China and we see some of the demand gains that people expect, that we will see higher imports.
When you built this, you, Stuart Wallace and Justin Kerrigan, built our hydrocarbon team. You had the courage to go downstream, out to distillates and out to refining and all that. What's the story, in America, but frankly in Europe too? What is the refinery story as we possibly revisit 100 a barrel?
Refining remains tight. We came out of the pandemic with less refinery capacity in America. We came out with less refinery capacity in Europe, and that's being added in the Middle East. It's being added in China. But that means people are moving oil all the way to Asia to get refined, and the product all the way back to Europe to get consumed to some extent. And on top of that, you've got Russian sanctions, which are just accentuating those kind of trends.
I can't keep up at the moment, Will. This is not the year that many people anticipated just a month or so ago. Well, great to have you with us in New York. Brent crude right now up by 1.4%, $83.80. WTI up by 1.3, $78 and about 50 cents. We are about 10 minutes away from the CPI report. It's just around the corner. Equity futures going into that up 0.4%. It gets real when Mike McKee drops by the studio. Mike McKee's dropped by the studio. Morning, Mike.
Speaking of the way things change, you never want to see me on CPI days till the last year or so.
Well, here we go.
Now it's become big.
Supercore, or rather PALCORE, as you said to me yesterday.
PALCORE is the ex-housing number, which is not forecast, but people expect it to continue to go down because the contemporaneous indicators suggest that rents are falling, and that you take housing out, the rest of core hopefully is falling. Interesting thing is CPI on a headline basis, and we'll thank Will for this, is expected to post its first negative quarter or month rather since May of 2002, because energy prices have gone down. So we're expecting a 0.1% drop there. The only thing to keep in mind, and I brought a chart along. You can't see it on radio, obviously, but in
it's good on radio.
In August, there was a forecast for a negative 0.1%. and it did not happen. As a matter of fact, inflation started to go back up again. So there is that risk. It's maybe not two-sided for the markets, but it is there.
People get very frustrated when we start taking out all the stuff that's important to them: food, energy, shelter. Why is this relevant? Why is it useful?
It's useful for the Fed in its analysis because they're trying to figure out whether inflation is going to come back or keep going down. And so they're looking at the individual components of the CPI report to see what's happening. And the problem is that inflation, especially the core, has been pushed up by the way the Bureau of Labor Statistics calculates the housing component, which is rents. And then they ask people, if you were to rent your house, what would it rent for today? And that's how they figure out.
That's how they figure it out?
That's how they figure out what housing prices are. Well, you don't buy a house every day, and people don't sign new rental agreements every day. So it takes a very long time for the data to get in and out of the report. But then there are people like Zillow and Apartments.com who produce contemporaneous numbers that show it going down.
They don't use actual rental contract statistics, or they don't use home ownership statistics. They ask you, what if you did this? Is that how they do it?
Well, they use rental statistics for the rental part, but they use them on a aggregate basis, everybody. So if you signed your lease a year ago, yours is still in there, and that increase is still in there. For homeowners, yes, that's the way they do it, is they ask people what they think their house would rent for. The idea was, this really came about during the great inflation of the 1970s, 80s, because mortgage costs were so high. And so they wanted to take mortgages out of the calculation.
Do they do it? They tell me they don't do it this way in England.
I'm not sure if they do it that way in the UK. I hope they don't. But I don't know for sure. It's kind of bizarre, isn't it? When people find this out for the first time, they really scratch their heads about it.
Do you trust the statistics, Mike, if they're guessing inflation in housing?
You kind of have to, because
there's no alternative. It's like China.
There's no alternative. They've been doing it for so long that I assume that they have statistically smoothed it enough to have a confidence level. I mean, most of these numbers are supposed to have a confidence level of 90%. So
can we finish on the leak? And I say the leak in inverted commas because we don't know if there was a leak.
We need to pull that up, the Bloomberg chart.
So what happened?
Well, in the last minute before the last CPI report, trading was 3 times what it was after right before the normal CPI reports for the last 2 years. So somebody either knew something or thought they knew something.
Guys,
and
it was Bramo's kids on the couch.
It could have been. But maybe that's why she's not here.
That's why
winning the lottery.
In all seriousness, though, this is a problem.
Yeah, the Bureau of Labor Statistics investigated and said there was no indication of any leak, any information getting out. So how did this happen? We don't know.
Out of interest, when does the administration find out about this number? We know when they find out about payrolls. What about CPI?
Council of Economic Advisors gets it the night before. And they can share it with the president, which often they do, I suppose, if it's good news. Don't want to be the one bringing him the bad news.
No.
But other than that, it should not get out.
The president, of course, speaks at 10 a.m. Eastern Time. Mike, this was cool. You're going to stick with us.
Yeah, I learned a lot.
The inflation data is about 4 minutes away. Going into it, equity futures up by 0.4% on the S&P 500.
Lift.
Yields lower by 4 basis points. Your 10-year, 349.49. Your inflation report. I'm next.
While Teslas and the like make for good headlines, the reality is that even if every car on the roads today went electric, it wouldn't be enough to curb global emissions to avoid catastrophic climate change. Greenhouse gas emissions from transportation account for about 29% of total U.S. greenhouse gas emissions. So what about the other 71%?
Buildings across America burn fossil fuels to operate. What we want to do is make that all electric. Instead of burning oil and gas to give us the energy and electricity we need, we want to do 100% clean energy, all electric. We want to turn buildings into Teslas. Just like a Tesla or an electric vehicle is all electric with no fossil fuels, we want to do that with our buildings. And if we can do it in one building, we can do it in all buildings. And if we do it in all buildings, we'll reduce 30% of U.S. greenhouse gas emissions.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
20 seconds away from the inflation data in America. Your market with a bit of a pop higher going into this print. Equity futures up by 5 or 0.6% on the S&P 500. In the bond market on a 2-year, we're down about 2 basis points into the print. On a 10-year, we're down about 4 or 5 basis points. I can tell you we're pop higher briefly on euro dollar, just hitting 108 briefly. Back down again right now with your inflation report. Let's get to Mike McKee. Hey, Mike.
Well, it looks like we are bang on in terms of the forecast for the numbers that come in. The December numbers come in with the headline month-over-month change down 0.1% as forecast. The core up 0.3 as forecast, and that pushes the annual rates to 6.5% for headline, 5.7% for the CPI ex food and energy. Doing the calculations here and see if I can get that housing one. I haven't got it yet, but we'll get it for you as soon as we can. The J. Powell number that everybody is looking for. Taking a look at the percent changes, it looks like food was up 0.3, which is a bit of a surprise. It's down from 0.5 the month before, but there was a thought that might go down a little bit further. Energy down 4.5%. Will Kennedy just left and took his gasoline prices with him. They were down 9.4% in the month of December. So if you were driving, you noticed that. Natural gas was up 0.3, which is kind of interesting. That's the opposite of what we had been seeing. Used cars down 2.5%. That's always a big contributor to this. Apparel prices were up 0.5%, which a bit surprising. And then the housing numbers in terms of shelter up 0.8%, which is 0.2 higher than it was the month of November. So that is an issue for the Fed, and we are just going to have to wait just a second and try to get the updated math done here on the
John, why don't you do the markets while McKee does the updated math?
Well, let Mike work that out. I can tell you how the market's responding to it. Initially lower in the equity market by about 1/3, responding as if it was looking for a bit of a downside surprise on inflation and didn't get one. But these are early dates. We're only 2 minutes into this, so we've got to look over all the numbers. Yeah. At the front end of the curve, yields are higher by 5 basis points on a 2-year to about 4.27. On a 10-year right now, up about a basis point to 3.55. We did see briefly going into the print, euro dollar, have a look at 108. New high of the session, 108.10. I can tell you euro dollar now negative just on the day, Tom, by about 0.1%, and now not even that.
There was a play a little bit across equities, bonds, currencies, commodities towards a more what I'd call benign statistic, and instead we didn't get gloom, but we got spot-on statistics. We haven't seen the revisions yet. Maybe Mike has them. But I'd also note, John, beneath the radar, it is claims Thursday, and jobless claims are just stunning 2 weeks in a row. They're not as important as inflation, but this is a low number. Is a fully employed America is a non-McKee generalization. He would never say that, but there it is. And
I'm employed, which counts as fully employed.
For you, Mike,
5,000 for initial jobless claims after 206 last week, but these are also still holiday adjusted, so we kind of give with a grain of salt, but it doesn't suggest any problem.
Do you have this
in the
key
labor
Powell
market
statistic?
We don't have the total. We don't have the accurate one, the one that I want to use yet.
Okay.
But we do have the calculation that the BLS makes of less food, shelter, and energy, and it was down on the month by a 0.1% after a 0.1% drop last month. So it looks like no change, still going down without housing. The difference is the BLS number includes lodging away from home, including hotels and things like that. And most economists think that Jay Powell is not talking about that. He's talking about rent and home prices.
25 for the Fed now, early February?
No reason to think that they wouldn't at this point. Most of them have been saying we want to get to 5%, but they haven't said we need to go as fast as we did before.
Tap on the back for Wall Street. Just a little bit of a pat on the back, Tom. Bang in line with estimates, this number. Mike McKee, thank you. Looking at the price action right now, equities down just 0.1%. As I keep saying, early days will take some time to process this. Yields are higher by a basis point at the front end, not a major move. 423 in the FX market. Euro dollar now punching back towards 108. So there you go. The FX market all over the place around this print in the last couple of minutes. 108 at the moment on euro dollar, positive 0.4. If you're just tuning in, the data as follows. Headline year-over-year CPI drops to 6.5 from 7.1. Bang in line with estimates. A lot of people very focused on month-over-month core. Strip out food, energy over the last month, 0.3. Bang in line with estimates, Tom, at 0.3 and up from 0.2 in the previous month.
Long ago and far away, and we'll have Mike drop in here as he gets more information, particularly on those key ratios. Long ago and far away, we used to worry about what sandwich Chairman Greenspan was carrying into the Fed meetings or maybe into the inflation report. Vincent Reinhart is expert at that. Vincent Reinhart is with Dreyfus and Mellon and, of course, led all of our economic research at the Fed during the Greenspan years. Vince, just perfect to speak to you this morning. Thank you for joining. This micro-analysis of data post-pandemic, have you ever seen anything like it?
You mentioned Alan Greenspan, and he loved getting into the details of the data. So, the fact is, the Federal Reserve Board building is pretty big, and it's stock full of economists, and they look into the details of all these reports. I think that the Fed, Chair Powell, has been extremely transparent about a very specific mechanism about inflation, the super core or the Powell's power core, really getting down into the third level of detail.
I want to make clear, John, we need to continue to look at these markets. They're narrow moves, but nevertheless, we were green on the screen with a real plunge down. And John, just as Mr. Reinhart gives us wisdom, boom, we come right back in the equity space.
Interesting to see the FX moves as well. That's a 2% move on dollar yen, Tom, which I think is what you were looking for. On
yes, thank you. I missed that.
Move.
We're
that's
now below 130.
It's a break of 130. 129
stronger yen there, and a euro dollar 108. We'll continue to look at those major pairs here with Vincent Reinhart as Mike McKee dives deeper into the CPI report. Vince Reinhart, is this inflation completely pandemic induced, or do we have issues that harken back to when your lapels were wider?
So I never wore that wide lapels, Tom, but I think the answer is, why is Jay Powell going into the details? Because it's the mechanics of inflation that has them worried. Inflation is embedded in the persistent part of the basket that households consume, that services less shelter that Mike keeps mentioning, that Jay Powell keeps mentioning, that shows up in all those speeches. And in some sense, yes, we got an inflation report exactly as we expected. We also got a reminder that the labor market is running pretty hot. From the Fed's perspective, aggregate demand has momentum. That's putting pressure on resources. That will put pressure on wages and therefore on prices. Maybe not this month on prices or wages, but the mechanics are there. The mechanism that you worry about inertial inflation is there.
Reinhardt and Orphanides and others from another time looking at the long term. We'll continue with Vincent Reinhardt of Dreyfus and Mellon, looking at the micro short term as Michael McKee. You're diving into the pages and pages of data, Michael. What do you see?
Yeah, looking at the core services ex housing, which, as I mentioned, you take out the owner's equivalent rent and rent of shelter, and it is up by basically 25 basis points, which is a little bit higher than that BLS number that we gave earlier. Rent of shelter rose 0.8, which is more than last month, and it rose 0.8 in terms of primary residence, which is the same as last month. And then owner's equivalent rent up 0.8. A tick higher than the prior month. So we're still seeing the impact of higher home prices and higher rents in the CPI report, which is what Jay Powell's trying to take out so they can get a cleaner read on where core inflation is.
The dollar weakness, the market story of the day, without a doubt. Equity futures just about unchanged on the S&P 500. In the bond market, you've got this drop away, just falling away now at the front end of the curve again. We're down 5 basis points on a 2-year to 4.17. They're looking to hike again over at the Federal Reserve. This 2-year keeps on rallying. Your 2-year, 10-year spread still about 66 basis points, so no real drama there. But in the FX market, here's the move for you on dollar yen. Dollar yen briefly breaking through 130 with some yen strength. That was a 2% move. It's now a 1.7% move. And I can tell you, just before the print and after the print, euro dollar had a look at 108. Now back, Tom, to 107.73.
I'd also look at Mexico with some Mexican strength and renminbi to 4 digits, 6.7375 strong yuan as well. Vincent Reinhardt with us, and thrilled he could join this morning. Vincent, is there an underlying theory at the Fed, or are they literally making it up as they go? Is there Oken? Is there Phillips? Is there Taylor? Is there Reinhardt? Or are they flying blind?
They're doing the best they can, and it's actually pretty conventional. Inflation has a number of parts to it. John Williams talks about the inflation onion. We've gotten the good news on the outer shells. Commodity prices off, energy prices in particular off a lot. Next shell in, goods prices are doing better because supply chains have mended. Market economies work and shift resources around. They're worried about the core. They're worried about the inertial part of inflation that is importantly gets embedded into contracts that are written at different times. And so it's a slow slog in which inflation has built, and they're worried it's going to take a while for it to come down. So, yes, I think markets got what they expected, even though they were hoping for good, even better news. Don't try to get between a rally and reality. But the reality is, Ed's looking at the details, and the details are supportive of 2 of the 3 planks to the story they rely on.
Hey, Vince,
there's
this was great.
Momentum, slack, maybe not so much right now, wages and prices, but the other 2 things are the reason you worry about future wages and prices.
Vincent Reinhardt there of Dreyfus and Mellon. Hey, thank you, Vince, as always. Equities down about 0.1%. No real drama here into the bond market. Bit of a rally at the front end. Yields lower there by 3 or 4 basis points. Just putting a little bit more pressure on the US dollar. Coming up in the next hour, Jim Bianco of Bianco Research on some of these moves and what it means for the Fed. Priya Misra of TD. TK will throw some LIBOR in there for you, okay?
Please do.
And Jonathan Golub of Credit Suisse. Next stop for this market. Earnings tomorrow morning.
Yeah, which matters. I'm sorry, Mike Wilson's nailed this at Morgan Stanley. This time, it really matters.
We'll see. Hey, Mike, that was great. Thank you, Mike. Appreciate it. Mike McKee's going to join us at the top of the hour.
I'll stay with Tom, too.
You're going to stick around with Tom?
Yeah.
That's kind of you. Okay, I'll see you in about 20 minutes. Okay. Hey, Tom, that was great.
Yeah.
A lot of people messaged me this morning, wanted to know what was in that tank a little bit earlier on.
Oh, yeah.
I send you the corks from New York. This is Bloomberg.
Swiss aperitif.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Ukraine, fierce fighting is raging in a town in the Donetsk region. Ukrainian military officials say that Russian attempts to capture Soledar are failing. It's located just 6 miles from the strategic city of Bakhmut. And capturing Soledar would be a symbolic victory for Moscow after a number of defeats. The U.S. and Japan are taking steps to counter the growing challenge posed by China and its ties with Russia. They announced plans to strengthen defense cooperation on land, at sea, and in space. The U.S. plans to reorganize its forces in Japan so it can deter and respond better to increasing regional threats. More than 7,000 striking nurses at 2 New York City hospitals will working conditions. The strike began Monday morning after 4 months of contract negotiations fell through. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Countdown to the Close.
Welcome to Bloomberg Crypto.
Bloomberg surveillance, an eventful morning to say the least. Lisa Bramlett and John Farrow, Tom Keene with you. Lisa on assignment, Farrow getting ready for the 9 o'clock show. Thrilled you're with us on radio and television. And thrilled Michael McKee's with us because the engineer from Wharton, one of the people I lean over and I really listen to, Mr. Harker of Philadelphia. Michael McKee, Harker Speaks.
Yeah, Pat Harker giving an economic outlook this morning up in Philadelphia. And basically, this was before the CPI came out, but he said he sees signs of inflation cooling, and he thinks the 25 basis point moves will be appropriate from now on. And he is a voter this year. So he's already in that camp, and the numbers come out, Tom, as expected, with inflation continuing to fall. So no reason to think that he would go back on that. He also says he does not expect a recession, but I don't think you'd ever get a Fed official to say we're going to have a recession.
They're not going to say, but 1% GDP is not in the zeitgeist right now. Am I right? Still, the zeitgeist is gloomy as it was 4 weeks ago.
Well, it's starting to come up a little bit, and you've noticed some people beginning to talk about the soft landing possibility because the data have come in stronger than expected for the most part, and so that's possible. The Fed had forecast 0.5% growth this year. Now he's up to 1%.
An adult like you, are you looking to February 1, or are you already cheating and going out to what I believe is March 22?
Well, I think we go out to March in terms of the major question for the markets going forward, because if we've got Harker at 25 basis points, and we heard from Susan Collins yesterday, 25 basis points, I think you're looking at a Fed that's going to be committed to a lower rate increase. And then the question is, do they go beyond that? Do they continue to raise rates, and then do they continue a 25 basis point move? That'll be the argument for the markets as we collect data between now and March.
Michael McKee, thank you so much. Much more from Mr. McKee through the morning here as he dives into the pace of inflation in America. We're going to Seguin right now with red and green on the screen. The VIX has come in sharply, 20.24, an important statistic there on an S&P that printed 4,000 earlier. And we are privileged for a repeat performance from Dana Telsey's Chief Executive Officer and also of research at Telsey Advisory Group on the pulse of American retail. I've got to go to the gossip of the moment. And I'm going to say this with respect. Richest guy in the world, a guy that took Louis Vuitton and figured out how to do luxury fashion. There's nepotism involved here. How do you address, as one of the most grizzled veterans on the street, when it is about relationships? If it's Prada in relationships, or it's LVMH with his daughter coming over to run Dior, is that a plus or a minus?
Right now it's a plus, and the reason why, these aren't new people going into those business lines. She's been involved in Dior. She's been there 20 years. So you're getting experience, and you have to say the succession planning. But look at the depth of talent underneath her, and frankly, in each of the brands. What they have with 75 brands at LVMH, they have the experiential talent to move everyone up the line, and that's what they do.
These have log convexity. These luxury groups off China opening and the rest, you predicted this with your team. They're a moonshot right now. Can you acquire shares this morning in these heritage luxury brands?
You can, because the next development will be the reopening in China and that China consumer. We've already heard from others. I mean, you look at what Neiman Marcus most recently said about the strength of the holiday season, and you're seeing the product innovation driving demand.
Right.
So I think it's going to be a good season. But let's keep in mind, we're still having consumers in all areas with the volatility of the market. There's been a step down in terms of what the rate of growth is compared to last year and even in 2021.
So one more question on luxury. Can you overweight luxury now? Is the market is overweighting luxury?
I don't think the market's overweighting luxury yet.
Really? With the moonshots we're seeing in some of these stocks?
I think there's more opportunity when the holiday sales come in, because also the ability to drive strength out of China, that's going to be the next
single best
evolution.
buy now in luxury, particularly when you look to China. What's your single best buy right now?
I mean, it's LVMH in the international, it's Tapestry in the domestic. And the other one, Ralph Lauren. Ralph Lauren has a significant opportunity.
We'll go to that in a moment. I mean, you're killing me. You know how much I hate this phrase. This is Coach, right?
Right, yes. But it's Coach, it's Stuart Weitzman, and it's Kate Spade. And what they've been able to do in resetting prices, updating the brands, capturing
they had a home run in the
customer
Tom
base.
Wesselman. They did the Tom Wesselman thing. Is that where we're going, where these brands come in and they get famous celebrities and artists? Like they'll do a Dana Telsey coat or something like that?
I don't know about that. It's collaborations.
Wesselman?
They matter. Collaborations drive demand. And you know why?
Right.
They go viral on social media. Everyone sees them, and there you go. Sell-through happens.
Does social media help Macy's move forward, or the big boxes that Joe Feldman looks at?
Yeah, it does. I mean, we just had a dinner with Macy's the other night. The personalization and pricing science that's being allocated to their merchandising is really helping them navigate a consumer environment that's definitely a bit more challenging for the income level of the Macy's consumer.
How do they manage expenses? At that dinner, did they talk about the cost rationalization of suburban malls that are off the mark?
Well, not only that, but what about the Bed Bath & Beyond stores that could come up for play, and there's a healthy demand, even in Marketplace by Macy's or the off-pricers want those boxes. Those are good boxes in great locations.
For the same concept?
For Macy's, it's a different concept. It's a smaller Marketplace by Macy's concept that they put in there. But let's see what develops with these Bed Bath & Beyond locations.
My recollection is Telsey Advisor Group avoided the carnage of Bed Bath & Beyond. Let's be constructive. Why did they fail? What's the best practice forward for retail not to do a Bed Bath & Beyond?
You need branded merchandise under a halo, not just private label brands, And also you need to be able to continue to innovate the offering. And yet home goods out there taking share, and you didn't play up what made Bed Bath & Beyond so special. Go in there and buy more than you originally expected.
Got a lift to the market, the VIX in a stick here with Dana Telsey, a Telsey Advisory Group, watching this carefully. Less curve inversion than what we saw off the CPI report. Dana, I've got to wrap up with the guy who is iconic. Ralph is Ralph. Does he have nepotism in play like Mr. Arnault, or does he have a succession plan? He's a bit ancient.
I think overall, look at the team that you have there now with Patrice Louvet and Jane Nielsen, CEO and COO. They're taking the brand to the next level and modernizing it, and it's showing up in the numbers and the AUR, and consumers are reacting.
One question, single best buy right now for Telsey Advisory Group across all your team?
I mean, we have a bunch of names that
Amazon?
we're interested in. Joe likes Amazon. It's been a favorite name of his. But also, let's take a look at what some of these off-pricers are doing. I mean, the TJX, certainly we're watching. I would say that you look at Abercrombie & Fitch, and it's exciting.
Really?
Ralph Lauren, yes.
Do you know that Michael McKee almost was a model at Abercrombie & Fitch years ago on Fifth Avenue?
Well, you know, it's a different score today than it was then.
Yeah, but I would have been in the pith helmet.
Everyone knows this brand. They're getting resurrected again. How's Abercrombie & Fitch going to do it? What's the pixie dust this time?
The pixie dust this time is the Abercrombie & Fitch brand has aged up. It's better quality.
Aged up.
Yep, it's not the teens. And Hollister is showing some improvement in their assortment and getting the men's business too.
Dana Telsey, thank you so much. We're going to age up now and continue with Keenan McKee as we age up. Tell me about the ageless comments from Harkin, and also, Mike, what you see in this historic inflation report.
Well, Pat Harker is joining a crowd that says 25 basis points, and the numbers today justify that with a 1/10 drop on a month-over-month basis in December. Pushes the headline number down to 6.5%. So on the path to where the Fed wants it to be. Interesting thought here with Dana here is I'm looking at apparel costs, and everybody thought maybe we'd see a discount on that, but they're up 0.5% because men's clothes went up. Almost all of women's clothes fell. Men's and boys went up.
So the interesting thing there, company after company I spoke to over the past 3 days, men's is showing improvement, and all the retailers, inventory levels are coming down faster than expected, and that's going to be a good thing.
They told Tom he needs a new suit. The interesting thing is men's and women's shoes.
A bow tie.
Yeah, men's and women's shoes both came down.
This bow tie is over 20 years old.
That's why.
That's the problem. I look to wrap this up. Dana, I'm so sorry. I've got to go to Mike here as we drive forward into the Bloomberg morning. Mike, are we going to have the same inflation frenzy 30 days from now?
Sure.
I mean, this is
because it's all about inflation for the Fed, and the Fed's going to keep going or at least hold until they are convinced that inflation's going down to 2%, and we don't know what it's going to take to convince them.
John emails in from Manhattan. He says, ask Dana about when Tiffany opens. That's like soon, right? Like a couple months here?
Should be second half of 2023, brings more traffic to the whole area, has a restaurant in the business, in the store too. It's going to make 57th Street very exciting.
Look what they did to the prices of Schlumberger and that at Tiffany. Are you kidding me? The Arnauds are nuts.
I think they walk around saying, take the price up, it'll create demand.
That's good. Dana Telsey, thank you so much. Our economic report from Telsey Advisory Group today. Please stay with us. Markets all over the place. They lift. Futures up 20. Good morning.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
I've
been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
So now you've been at JP Morgan for about 25 years?
Yes.
Okay, and now you run one of the most important parts of JP Morgan, which is, I say, is the asset and wealth management business. What actually is wealth management, and how is that different than asset management?
Great question. The two are often used interchangeably, but they have distinctions. Asset management business is where we manage money on behalf of individuals, institutions, sovereign wealth funds, pension funds. We manage them in mutual funds, we manage them in ETFs, we manage them in single stock, single bonds, hedge funds, private equity, and the like. And that is the heart of the fiduciary business that we run here at JP Morgan. Wealth management is that plus understanding someone's entire balance sheet. So for the individuals where we manage money, we also help them with their mortgage. We help them with a loan that they might need. We help them with their basic credit card. And so wealth management is trying to help someone with their entire life, both their assets and their liabilities, their planning, their gifting, the legacy that they want to leave for their families, the 529 plans they need to prepare to get their kids to go through college. And it's a great insight into people's, entire journey.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
This is Bloomberg.
Live from New York City this morning. Good morning, good morning. Yields drop, stocks pop, inflation data in America showing some signs of cooling. Equity futures up 0.7%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Live from New York, we begin with the big issue. No fireworks here. Inflation data in America cooling once again, putting even more pressure on the US dollar as the Fed begins to lean towards a smaller move.
Inflation.
The CPI report.
The December CPI report.
There's a lot of hype for this number.
We, like the rest of the market, have no choice but to follow what Powell is focused on.
It's the beginning of the year. It's the last inflation print before the Fed meeting.
The economic models will tell you that we need demand destruction to get inflation to come down.
So really it's the labor market that almost matters more than today's inflation report.
In other words, we need a much higher unemployment rate.
The Fed is now focused on the sliver of CPI that is wage sensitive.
Powell's been very focused on wages.
Get rid of anything that's not attached to wages.
But the problem is, maybe inflation today is not driven by demand.
At this point, it's a lot more noisy.
For more, let's get to Mike McKee. Mike McKee, your read on things 30 minutes after that report.
Well, steady as she goes, the progress continues on inflation. There are a few hiccups here and there, but overall, it looks like the Fed can dial back its rate increases and start to think about when they might pause. The numbers come in bang on expectations, down 0.1% on the headline, up 0.3 on the core. Food prices up but decelerating. Gasoline prices fell off a cliff during the month. Apparel prices were surprisingly up a little bit, but we were just talking with Dana Telsey about that, and she said that's because men's clothes are selling better. Used cars down almost the same as the prior month. So some of the categories that had pushed inflation higher over the last year really starting to back off now, and that's true in the goods area. You can see goods prices are continuing to deflate, down 0.5%. From the 0.8 in November. Services prices, though, still going up. So that makes us look at the core services ex-housing number, Jay Powell's number, and that was up 0.3% in December compared to 0.1%, taking out rent and owner's equivalent rent. And that's a number that matters to the Fed because they know home prices are not rising anymore, but it still shows up that way in the CPI. So the question becomes, what does the Fed do from here? They were slow to react to inflation going up. Now are they going to be slow to react to inflation coming down? That's an open question at this point, although we do have Pat Harker from the Philadelphia Fed this morning saying he's ready for 25 basis points instead of 50. And Susan Collins said the other day she is too. We'll see who else joins that parade today. I think, John, one of the key numbers, and I just got this in from Omer Sharif of Inflation Insights, is if you look at it on a 3-month basis, the core CPI is 3.1%, and the 6-month is 4.5%. So we're really seeing a decline in sequential inflation that is taking hold here. You got to get rid of those base effects, and you're really seeing some movement. And so the Fed's going to be thinking about this now.
And Mike, it's happening with unemployment at 3.5% still.
Yeah, we could mention very quickly that we only had 205,000 initial jobless claims.
It's impressive.
Distorted by the holidays, but certainly no indication that we're losing a lot of people.
Mike McKee, thank you, sir. Counting you down to that opening bell, about 25 minutes away, 26 minutes away. Equity futures are higher by 0.7%. Seen a rally come into the front end of the bond market of the yield curve, down 10 basis points on a 2-year, 4.12% now on a 2-year, on a 10-year down 7 basis points to 347. And we're seeing a ton of dollar weakness as well. Euro dollar reclaiming a 108 handle, 108.22, euro dollar positive by 0.6%. With us now, I'm pleased to say, TD's Priya Misra, Jim Bianco of Bianco Research. Priya, first to you, your first take on this one.
Sure. So I think there were some positives in the form of this. Inflation has clearly peaked. I think we're seeing goods inflation continue to decline. What I'm a little surprised by the market reaction is that the service inflation, so service CPIs, shelter inflation, core services ex shelter, that's still high. It's actually accelerated over the last couple of months. I think if you take the Fed at face value, that's what they care about. I think the easy part of the decline in inflation may be underway. Goods inflation's declining, commodity prices are falling. The much harder part is getting that service inflation down consistent to 2%. I think the market thinks that, they can extrapolate this trend and that the Fed has maybe 1 or 2 more 25 basis point hikes. I think the Fed may have to actually continue to hike. So our call is 5.5 for that terminal rate. We're calling for a 50 in February. I mean, maybe that's a 25, but I think the Fed's going to say we're not done. I think the market's a little too optimistic, extrapolating that this decline in service inflation will continue. And historically, service inflation is very sticky on the way down.
Jim Bianco, are you on the other side of that argument?
Not really. I think that what the market should be focusing on as we go forward from here is where do we go next? Okay, inflation peaked, 9% was the high. That's the easy call. It's very obvious that that's happened. Are we going to 2% without any kind of intervention like a recession or anything else to dampen demand to get us down there? Or, as Mike McKee just pointed out, do we bottom out somewhere around 3 or 4%, the 3 and 6 month averages that we've seen? Is that where we bottom? Because if that's where we bottom, that will be unacceptable for the Fed, and that they will not be looking to pivot or they won't be looking to slow down the rate hikes. Yes, they'll move 25 basis points in February. That has been priced in for a month now, that it would be a 25 basis point move and maybe 25 basis points after that. But I think the narrative and the attention should turn to how far down are we going to go, not has inflation peaked.
This is what Sarah House of Wells Fargo is getting at as well. She says we're approaching this last mile, this big effort, and that last mile will be the hardest mile. Priya, you've made the same point. Just how much demand destruction you still think we need to get inflation to where the Fed wants to see it?
So I think we need a lot more demand destruction, particularly in the labor market. I think businesses are hoarding labor. Wages did come down a little bit last week, but you still look at year-over-year wages well north of 4.5%, not consistent with 2% inflation. I would also argue the lags point, the long and variable lags. The Fed is looking at data right now, and that data on the labor market does not suggest that demand destruction. How forward-looking can the Fed be to say that we think this demand destruction will happen in the labor market 6 months out? I think if you take them at face value, they are saying they're responding to data as it comes in. So, our view is they are going to be late. And I think the market is cheering. We're pricing in more rate cuts at the end of this year, more cuts next year. I think that is a mistake because the Fed is telling us they're worried about the mistake of the 70s. They really want to see that 2% inflation. And my views are there are structural forces that's going to keep inflation high. Until the Fed accepts that and is perhaps okay with a 3% inflation, they are going to be really reluctant to, I would even argue, stop hiking, let alone start to cut rates. So this optimism why the 2 years falling is all these cuts getting priced in. I think that can get taken out as we hear from the Fed that they can stop at, maybe it's 5.25 or 5.5, and then they're going to just stay there for a very long time while that demand destruction that you talk about is an intended consequence of policy, and they have to see that through. And I think the market's already looking ahead to when can that easing happen. I think we'll be waiting for quite some time for that.
Priya, you mentioned what's happening right now. Neil Dutta of Renmark is pushing back against all these recession calls and talking about what he thinks is happening right now. Financial conditions are now easing and have been for a couple of months, supporting economic growth right now. Instead of long and variable, I think the lags are short and predictable. Jim Bianco, your thoughts on that? The fact that some people think we're actually seeing a re-acceleration in the US economy.
Yeah, there's plenty of evidence to suggest it. Initial claims this morning at 205,000. And there really isn't a lot of evidence that the economy is slowing. When Priya says, we need to see more demand destruction in labor, I want to say we need to see any demand destruction in labor right now, because 3.5% unemployment, 205,000 in initial claims, and still printing 200,000+ for payrolls every month, that's not demand destruction at all. And if those numbers continue to move forward from here, it's going to be hard to bring that wage inflation down, which is at 4.5%, I think much below 3.5 or 3%. And according to Powell's, services ex housing, you're not going to see inflation, dip into a 2 handle without that demand destruction. And if we don't get it, then we're going to have to pivot that narrative, as I was talking about earlier, to not just that inflation is peaked, but how do we get to 2% without a recession? And if we come out of a recession, does inflation just bounce right back up above 2%? And that's an uncomfortable question for Wall Street right now.
Mike McKee mentioned Patrick Harker a few minutes ago, leaning towards a 25 basis point hike over at the Philly Fed. He says this, though, in response to some questions in the Q&A, favours rising rates a bit above 5% and then pausing. Now, to your point, Priya, if we take the Fed at face value, they're not cutting interest rates. But I think the problem at the moment, Priya, is that I can't find many people that are taking the Fed at face value. Can you?
I think that when you listen to the Fed, all they can sort of tell us is the reaction function. So maybe the markets understood their reaction function. I think where the debate in the market is the economic outlook. I think the market is a lot more optimistic than the Fed in terms of how quickly that inflation will decline. Look at the TIPS market. Market's pricing in 1 year inflation at 2%. I mean, we're talking about will it settle at 3%? As a good thing, but the market's pricing in well below that. So I think the market pricing in these cuts is not so much second guessing the Fed reaction function. It's saying that the economy might be much weaker, that inflation might be much weaker, and so the Fed will have the ability to cut rates because inflation is back down. I think the uncomfortable question, to Jim's point, is what if inflation does settle at 3%? Then I think the Fed is telling us very clearly that they need a much higher rise in the unemployment rate, closer to, I would say, 5%, which we're very far from, before they can respond. So it's really this tension of what is the economic outlook? The Fed has one view, and I think the market is saying, oh no, inflation's now headed down. Just as we couldn't quite forecast how quickly it would rise, I think the market's saying, we've all gotten it wrong. Inflation is going to decline much faster. And I think that might be the disconnect, why the market is so much below the Fed dots.
Well, there's another dynamic we need to discuss as well. And Jim Bianco, that's China reopening. How much does that complicate?